the bank will, on paper, lend somebody this amount of money, but then when they look at it and go, oh, geez, if I borrowed that much money, it'll have a detrimental impact to my budget. So I'm not going to borrow as much as the bank will offer to give me. I'm actually going to borrow less. So knowing your numbers and getting your finance approved, I think, is definitely the next natural step in terms of, things that you need to consider when buying an investment property.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, how are we today? We are back again and Billy is actually looking 39.
Actually, I got told I look younger today, Andrew. So for the listeners out there who can't see or are not watching it on YouTube, I had a haircut and a shave yesterday. So I went shorter with the beard and I obviously look a little bit younger. So
yeah,
it's a good thing.
You just wiped off 10 years.
Nice.
You don't look 60, you look 50, Bill.
Damn it. So now I can't access my superannuation.
Exactly right.
All right, Andrew, what are we talking to everybody about today?
So today, bringing us back on track, we are talking all about some of the things that you need to consider before you actually look at buying an investment property. So not going to be, talking about, whether it should be a renovated bathroom or, whether it should be a big backyard or anything like that, but just really the financial considerations as to whether it actually fits your circumstances or not.
Yeah. Great. No, really good. And I think it's a really timely one because at least in our world where we're located in Melbourne, obviously Victoria has had some changes with stamp duty and that's playing a bit of havoc with people in terms of the cost of holding properties. So we are doing a lot more work, a lot more projections and modelling around investment properties and what that looks like. So I think the first one, which is probably almost obvious, but it needs to be said, but how does this fit in with your long-term strategy? So when you think about your wealth creation journey, how does having an investment property fit into that? Does it work? Does it make sense? What does it look like?
Yeah, absolutely. And I think it's a really important consideration that it often can get missed. I mean, there's many ways that it can get missed, but I'll use an example just from a meeting that I had yesterday. I was talking to a couple in their 50s, and the conversation was around, hey, we're thinking about adding an investment property into the mix. Can we, get started on putting something together for that? And for someone in their 50s or in their situation, the consideration is, okay, well, what's the purpose for the investment property? Are we going to purchase the investment property with the intent to have some capital growth and sell it at the time of retirement? And their expected retirement timeframe was at age 60, so in 10 years. Mm-hmm. Or is the intention to purchase this property and pay down all of the mortgage and use it for a retirement income? Or is the intention to still have some mortgage left over and pull some money out of super at that point? I mean, what's the long-term strategy for this and does it actually fit into it? Once we started to unpack that, it's actually probably not the best thing to be doing. We should be looking at X, Y, Z. So it sounds like an obvious one, but really a lot of people tend to think more around, hey, this sounds like a great idea. The property market hasn't been as buoyant as what it has been historically speaking. So there's an opportunity to get in and you get excited and you think that something's a great idea. And sometimes it's just, let's take a step back. Let's consider, what it looks like and really whether it actually fits into the piece.
Yeah. And I think that's a really good conduit into the next thing that I wanted to talk about, which was getting finance approved. So not only just getting finance approved, but also making sure that you know your numbers. Yep. So what does it look like in terms of, okay, yes, finance approved, what can I borrow? But then what does it look like in terms of the impact that it will have on your household budget? Because, unless you're putting down a really big deposit or by some miraculous event, you get a, really big yielding or a high yielding property, you're going to be in most instances in a cash flow negative position. So needing to know what those numbers look like and then making sure that you're comfortable with that. Because often when we're going through this process in our business, what we tend to see is that the bank will, on paper, lend somebody this amount of money, but then when they look at it and go, oh, geez, if I borrowed that much money, it'll have a detrimental impact to my budget. So I'm not going to borrow as much as the bank will offer to give me. I'm actually going to borrow less. So knowing your numbers and getting your finance approved, I think, is definitely the next natural step in terms of, things that you need to consider when buying an investment property.
Yeah, absolutely. Absolutely. So know what you can spend or know what the bank will lend you, because you need a pre-approval before you bid. I've had some instances where someone hasn't had a pre-approval and they've already bid on the property. But in addition to that, know what you actually can spend and what fits into your household budget, because the last thing that you want to do on such a long-term asset is incur all of the costs of purchasing an asset and then in a short period of time need to sell that asset because it doesn't fit into the cash flow side of things. Bills, 10% deposit, 20% deposit, mortgage insurance. I really like this topic because you tend to find people are on either end of the spectrum. But what do? Do we pay mortgage insurance? Do we wait? What's the best course of action?
I mean, look, there's never necessarily one correct course of action and one decision to make. There's so many different, scenarios that you could play out. So I'll play out a few of these now. But if you are more concerned around, say, time, so you want to get in as quickly as you can, you'll go with a lower deposit. So maybe a 10% deposit, so you don't have to wait that additional time to save up to 20%. So you might say, okay, I'm prepared to do this faster with a lower deposit, but I'm prepared to pay lender's mortgage insurance in order to do that. But the flip side of that is that then you've borrowed 90%. So it means your repayments and your serviceability are going to be more onerous. Then on the flip side, you may be looking at this and going, okay, let's do it the other way. I'm prepared to wait longer, save up a 20% deposit, avoid mortgage insurance because I can't stand the idea of paying for an insurance policy that benefits somebody else. Use that extra time to save the deposit. But what it might do is it might change the repayments to get to a certain stage from a serviceability perspective that you're more comfortable with. So there's no right or wrong way when it comes to this. It's just a matter of working out what is appropriate for you. And I think it comes back to what we were talking about before, where it's, making sure that you know your numbers.
Yeah, absolutely. And know how much you're saving. I mean, it can change, or the scenario can change depending on your savings capacity. I mean, if you're saving at a really rapid rate and it's not going to take you that long to get to the 20% deposit, then it may be better off, putting the investment property aside and waiting until you've got that deposit, because we're at least at the moment, and at least in Melbourne, I mean, different story for the rest of the country, but we're in an environment where property prices are not rising at the rate of as what they have been in the past. So if property prices aren't, running away and they're not happening as quickly as what they have done, then you probably have a little bit more time to, put some savings aside, get a bigger deposit, pay less or no mortgage insurance, and get into the property. But if it's going to take you an extra, 2, 3, 4, 5 years to get that extra deposit, then you may look at it on balance and say, well, yes, I might pay 10 grand in mortgage insurance, but what's the likelihood that the property is not going to be worth 10 grand more in that amount of time? So it's a matter of look at your circumstances, look at the market, and make a logical decision from there.
No doubt. Andrew, ownership structures. How should we be thinking about this? What do we think about?
Look, there's a number of different options. People sometimes like to get a little bit too fancy with it. But
it sounds great.
Yeah, it sounds amazing. Own property in a trust. It sounds great, or own it in a company. But look, you can own a property individually, so you can hold it in your own name. You can own a property in a spouse's name, so a spouse will hold the asset. Mm-hmm. You can own the property in a trust, so number of people that sit within a trust. You can own a property in a company, so a company can purchase it. Depending on your circumstances, depending on what is right for you, will determine the ownership structure. So the big caveat that I'm going to put on this is get advice. Yeah. because it's really easy to make a very, very big error. I've seen people, holding an owner-occupied property that they live in a company, and yep, it sounded great because they got some deductibility through it, and now all of a sudden they're paying land tax on the property that they're living in. It's a property in Brighton. It's super expensive. The land tax bill is 30 grand. So there's considerations not just for the tax implications now, there's considerations for the capital gains implications later. Yeah. There's asset protection that comes into it. If you're self-employed, do you need a separation of, personal assets and business assets? So all of this needs to be put into the blender. And I think that it's really important to just get advice, because simply nominating it in a spouse's name might be the best scenario. Putting it in a trust might be the best scenario, but you're not going to know that unless you're having a really deep dive into your circumstances, into your goals, and what the likely outcome is of that property.
Yeah. And it's really easy to skip that step as well too, because, when you are purchasing a property, you get, excited. It's a big decision. Everybody loves the idea of it. Go straight for it. Bang, away you go. But if you just pause, get that advice, just double check it, it can really save a lot of heartache and pain and money down the track. So yeah, that's definitely another one.
And if you are in that heartache and pain, in that you think that, hey, I might have actually made the wrong decision. I might have, put a property in a company or in a trust or in a structure that's not necessarily right for me. Get some advice and look at what the implications are of it, because it may be worthwhile swallowing that bitter pill now for a much greater benefit at a future point in time. Or it may not be. It may be worthwhile just continuing the course and seeing how things go at a later stage. But just get that advice as early as you can.
Well, talking about getting that advice and avoiding that pain, I think the other consideration that we're starting to see, at least in our world anyway, a greater uptake of using buyer advocacy services. Yeah. So pretty straightforward. You're talking to somebody who's looking at property each and every day. They get an understanding of your requirements, your circumstances, basically what you're looking for, and help guide you into a position where you're making, a better decision, because you're using a professional that looks at this stuff every day to guide which way you go with it, because it is really easy to make a mistake. From a real estate agent's perspective, with all due respect, obviously they want to sell the property on behalf of the vendor. So if they can sell a property, they're not really concerned if it meets your needs or not. Whereas if you engage with a buyer's advocate, they will help you to, one, alleviate the heartache and pain and the stress that comes with it, but to hopefully buy you a better property that will result, well, at least in this instance, in a greater level of capital growth if it's an investment property, than you ordinarily could do by yourself, because they're industry experts and they're looking at it every day.
Yeah, absolutely. I mean, for the vast majority of people, if you're investing, most investment properties, at least in Melbourne, you're talking about $600,000-$700,000. If you're investing $600,000-$700,000 in anything, you're probably getting some form of advice. Yeah. So the analogy that I use is, well, if you're getting that advice investing in anything else, then you should probably get that same advice if you're investing in a property. Whether it's as simple as, hey, I just want to pulse check where I'm at, what I'm thinking, and the type of property that I'm looking at, or whether it's going down the full service of, sourcing, finding, and advising on a specific property, is up to you. But I do think that there's some value to be had in just at least having a conversation with a professional around whether it's the right property. And sometimes what we're seeing is people using a buyer's advocate to be able to diversify their own property portfolio as well. So maybe you've got multiple investment properties, maybe you're adding another one into the mix, and you want to have some diversification by holding property in another state. So a buyer's advocate can be a really good way to, open up a market that you may not be as familiar with, and may not want to travel to every weekend for opens and auctions.
Yeah, and look, I think when you run the numbers back, in the length of time that you anticipate to own the property versus what you'd spend on those services, if you look at that and say, okay, what does it look like over the course of the ownership period, it's actually reasonably cheap to get you into a position to not make a mistake.
Yep. Exactly right.
Obviously, we're big advocates of getting advice because it yields better results, right? Plain and simple. Andrew, from a cash flow perspective, buffers, banking strategies, P&I, also principal and interest only. What do we think about when it comes to, I guess, the serviceability of it?
Yeah. Look, maybe a controversial opinion, but if you can't afford principal and interest repayments, you shouldn't be buying an investment property. That's my opinion. And I'm sure that there's people that will have a differing view, but I don't think that you should be I don't necessarily think that you shouldn't not be making interest only repayments. So yes, it's a worthwhile strategy on an investment property to make interest only payments and put all of your additional principal repayments against your owner occupied property. So I'm not debating that fact. The fact that I'm debating is if you can't afford the property once that interest only period expires and you're on principal and interest, then you just shouldn't be buying a property. Because the difference between principal and interest only, I mean, it's significant, but it's not life changing. And if you're that close to
the
line, I just don't think that you should be purchasing an investment property. So buffers are really important, making sure that you've got a significant cash flow buffer for things like, there's repairs, there's maintenance on property, there's expenses that you will need to incur in the course of owning a property. But then there's also other things like land tax that came in that, people previously hadn't anticipated into their budgets when they were originally purchasing a property.
Yep.
And it's now 2, 3, 4 years later, and there's another expense that they need to incur in order to be able to hold that property. Do you want to be forced into a position to sell when maybe the market isn't necessarily its most buoyant? Or if you've got that cash flow, you can ride that out. And if it's not the right decision, sell it at a more opportune market. So making sure that you've got an interest rate buffer, making sure that you've got an expense buffer, making sure that you've got a buffer is imperative when you're looking at an investment property.
Yeah, and I think that's, along the broader topic or along the broader thinking around what's your risk mitigation strategy when you're looking at this. And it's not just particularly for investment properties. I mean, this can ring true with absolutely everything. But thinking about, okay, if something does go wrong, am I in a position, or can I get myself into a position with some planning around how I position myself to try and absorb that or navigate through that as best as I possibly can. So all of those things that you described, I'd put that in the bucket of what's your risk mitigation strategy? How do you think about that when you are approaching this? And, it comes down to a whole other range of other things, having insurances in place, what's your job security like? Have you got leave entitlements at work? All of those sorts of things. But yeah, that falls into the bucket of risk mitigation in my mind anyway. But yeah, can't articulate that and highlight that enough that's definitely something that you should be thinking about when you do go into something like these. Because if you do run into hot water, it's not that easy and it can't happen that quickly to basically sell a property. There's a process that you need to go through, and it does take some time to turn that from a property into a sale and obviously into money.
Yeah, and property is a very high entry and exit cost asset. So a lot of people forget that, in order to buy an investment property, you need to pay stamp duty. Now that could be 30 grand, that could be 100 grand, depending on the type of property that you're looking at. In order to sell a property, you're 99% of the time using an agent. So you need to pay an agent fee. You're also paying advertising when you sell the property. So those entry and exit costs mean that you might buy a property and sell it for, a higher price and still make a loss after you factor in all of the costs associated with buying and selling. So making sure that it's a long-term asset, making sure that you've got cash buffers in play so that if you do need to change direction, you don't need to make that on the snap decision. And probably the last one is not getting emotionally invested.
Yeah, and this rings true for all investments, regardless of the asset class, is when you're entering into this, you can't be emotionally invested. You need to be really focused because it has to perform because it is an investment.
Yep.
So it's really difficult, I think, especially from a property perspective, to get emotionally invested. You go there and you love the floor plan or you love what you can do and you can picture all these things, but that's not what you should be doing because it's purely an investment. It should be on the numbers, and you should be really clinical about it. You should be black and white.
Yep.
But property seems to sort of drag us in because it's an asset class that, realistically we all love.
Yeah, exactly right. So make sure that you're making a decision based off numbers, not off emotion.
That's it. Andrew, well said, well summarised. To our listeners and our viewers, thank you for today. If you've got a whole heap of information out of that, or if you wanted to have a chat about anything further, feel free to reach out to Andrew and myself. Andrew, thanks for today.
Thanks a lot, Bills. We look forward to catching you all on the next podcast, and like and subscribe.
Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.